Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Tata Motors results came out last week. The company has turned a corner and has come back into profits for the first time after 4 years. Little wonder the street is happy. The stock has done well in recent weeks and looks all set to continue its good run. The stock's upmove suggests that there are more investors who want to buy the stock than the ones who want to sell. There are more people positive on the stock than negative. And you can make that out on social media and other platforms as well. The commentary around the stock is quite positive. Well, if you ask me, my process suggests that it is time to exercise caution than be positive on the stock. Yes, that's correct. I may be in a small minority that believes that the risk-reward ratio of investing in the stock at the current juncture may not be in favor of the investor. Now, I may be right or I may be wrong. It is for you to decide. But let me make a case on why my process tells me that Tata Motors may not be a lucrative opportunity at the current price point. So here comes. Let me start by highlighting a very important statement made by Charlie Munger, Warren Buffett's partner, at recently held Berkshire Hathaway AGM. We are not so smart, but we kind of know where the edge of our smartness is. That is a very important part of practical intelligence. I will repeat that. We are not so smart, but we kind of know where the edge of our smartness is. That is a very important part of practical intelligence. I think this is one of the most powerful statements in finance. If you implement this and take this to heart, you can really achieve fabulous long-term returns. I'll give you an example of how Warren Buffett used it to earn $3.5 billion from an investment of just $0.5 billion over just 5 years. And then I'm going to use the principle to analyze Tata Motors and how even you can use it if you want. So here's the Warren Buffett example. You see, Warren Buffett's annual report for the year 2003 had an unusual entry. Perhaps for the first time ever, there was a Chinese stock in Warren Buffett's portfolio. And this was no small investment. The world's savviest investor had just spent a whopping $500 million to buy a small stake in PetroChina. It did not take long for the motive behind this purchase to be revealed. Buffett himself helped connect the dots in the Berkshire Hathaway AGM later that year. So Buffett said that when he picked up the annual report of PetroChina, he liked the fact that it controlled 3% of the world's oil production. He also observed that the company earned $12 billion in profits, same as some of the largest companies in the US back then. Therefore, it was evident that he was looking at a very large company. However, it was the company's valuations and its dividend policy that made him really sit up and take notice. He could not believe his eyes that the stock was trading at a P/E multiple of close to 3 times. Yes, that's right. One of the world's largest oil and gas companies was trading at a mouth-watering P/E of 3x. But wait, the best is yet to come. Hidden somewhere in the report was a very important disclosure by the management. They laid out a policy where they promised to pay 45% of the profits as dividends. In other words, if the company was earning rupees 100 profits, rupees 45 would be paid out as dividends to shareholders. Now, any doubts that Buffett harbored about the attractive valuations of PetroChina vanished into thin air. A 45% dividend payout and a P/E multiple of 3 times meant that anyone buying the stock was almost guaranteed to earn 15% return on investment in the very first year itself. Do the math and you'll realize that the 15% number is correct. one of the largest oil and gas companies in one of the largest economies of the world, was available at a big fat margin of safety. It did not seem to matter that Buffett had never looked at a Chinese stock before. It did not seem to matter that China had a different culture and different policies. And it did not seem to matter that Buffett had never met the management of PetroChina. All that mattered was that the downside at a P/E multiple of 3 times was very limited for a company like PetroChina. The upside, on the other hand, was quite significant. Therefore, although Buffett knew he had a great chance of making good returns in PetroChina, the actual gains may have surprised even him. He eventually sold PetroChina somewhere in 2007 and pocketed a cool US dollar 3.5 billion in profits. Yes, a decision that would have taken him only a couple of hours to make netted him and his firm a huge windfall. Now let's get back to Tata Motors. You see, Tata Motors has posted losses for 4 consecutive years starting from FY19. It last reported a profit in FY18. In fact, the period between FY12 and FY18 was a golden period for the company. It posted good profit numbers in each of these 7 years. So let's try and value the company based on profits it earned during this period. I am inclined to assume the average earnings per share of the company for this period as rupees 30 per share. This is because its diluted EPS ranged from rupees 22 per share to rupees 43 per share during this period, and therefore the average of rupees 30. You see, Warren Buffett valued PetroChina at a P/E multiple of close to 10x. However, we believe that for a company like Tata Motors, a multiple of around 14 to 15 times should be considered ideal. So here's how a valuation method for Tata Motors would look like. A P/E range of 10x to 15x. Now some basic math is all you need to figure out the price point below which the stock becomes attractive and the price point above which it becomes expensive. This makes Tata Motors overvalued considering its current share price of more than rupees 500 per share. Now I know some of you would think this kind of a valuation is ridiculous. A company like Tata Motors, which is innovating so well and which has some ambitious growth plans, does not deserve to be valued based on its historical earnings. It should be valued based on what its future earnings would look like. And it is here that there could be a huge upside. Now the point is not whether one should value Tata Motors based on its past or future earnings. The point is whether one is aware of the edge of one's smartness and whether one is valuing the company based on this assessment of smartness. Here's the Charlie Munger quote that I mentioned at the start again. We are not so smart, but we kind of know where the edge of our smartness is. That is a very important part of practical intelligence. So are you smart enough to predict what the profitability of Tata Motors would look like 5 to 10 years from now? Is that well within the edge of your smartness? It is certainly not within the edge of my smartness, to be honest. It is well outside it. I have very little clue about whether electric vehicles that Tata Motors is so heavily betting on will take off big time in India, or in what shape or form Jaguar Land Rover would be few years down the line. Please note that auto is a very difficult industry. The competition here is intense and winners keep changing. Therefore, to predict that the company's earnings will be materially higher 5 to 10 years from now is very difficult in my view. What I can, however, say with a reasonable amount of confidence is that Tata Motors is certainly capable of achieving an EPS of rupees 30 per share. It has done it in the past and there is a strong chance it may be able to do so in the future. Now the full year and the quarterly results of the company were announced last Friday. The company has performed really well and has posted an EPS of rupees 14 per share for the quarter. Does this mean we should extrapolate this number and assume that Tata Motors will earn rupees 56 per share for the full year? Multiplying this by 15 times would raise the fair value of the company from say rupees 440 to rupees 840 per share and make it a very attractive bet. However, again it boils down to whether rupees 56 is even possible for the full year and whether it's sustainable over the long term. Well, my answer would be that I don't know. I'm smart enough to know that it is capable of earning rupees 30 to rupees 35 per share and not smart enough to figure out whether it will earn rupees 56 per share going forward. This is my edge of smartness, to be honest. An investor with a similar level of smartness as me may find the risk reward in his favor at or below rupees 300 per share and out of his favor above rupees 500 per share. And this is precisely what Warren Buffett did. He exited PetroChina as soon as it touched his edge of smartness or his idea of the fair value of the stock. Please note that PetroChina went up another 4 times after Buffett sold his stake, but Buffett preferred booking profits much earlier. Holding on to the stock would have meant stepping outside his circle of competence or the edge of smartness, which he did not want to do. The same applies for Tata Motors or any other stock for that matter. You need to first figure out your edge of smartness or your circle of competence. It is this edge that will decide how you want to value the stock. As someone has rightly said, the size of your circle of competence does not matter. What matters is knowing its boundaries. An investor with a small circle of competence but a great understanding of its boundaries has a great long-term advantage over the one with a huge circle of competence but a poor understanding of its boundaries. Do let me know what you think of this viewpoint. That brings me to the end of this video. I'll see you again next time. Goodbye and happy investing.